Bank of America's bold silver price call is not guesswork, hype, or fantasy. It is built on historical math, capital flow behavior, and how investors react during late-stage financial cycles. Michael Widmer's logic starts with a simple but powerful concept, the gold to silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Right now, that number sits around 59, meaning silver is historically cheap relative to gold. To understand why this matters, imagine 2 toys that always move together in price over many years. When one becomes far cheaper than the other, compared to their usual relationship, it often snaps back violently. That snapback is where Widmer's $135 to $309 estimate comes from. In 2011, during a major precious metals bull run, the gold to silver ratio collapsed to 32, which would imply silver reaching around $135 if gold stays elevated. In 1980, during a period of extreme inflation, monetary chaos, and loss of confidence in fiat currency, the ratio fell to 14, implying silver at $309 per ounce. These are not predictions pulled from the air. They are historical reference points that show how extreme silver can move when capital floods into hard assets. Widmer also explains why silver could outperform gold, even though gold is considered safer. Gold attracts conservative investors, central banks, institutions, and long-term wealth holders. Silver, on the other hand, attracts risk-tolerant investors who want more upside. Silver is cheaper per ounce, more volatile, and reacts faster when speculative money enters the market. When investors feel confident enough to take risk, especially during inflationary periods or currency debasement, silver tends to move faster and harder than gold. This is why silver often lags behind gold at the start of a bull market but violently catches up later. Gold moves first as fear rises. Silver explodes later when confidence in hard assets becomes widespread. Widmer's statement that silver may overtake gold does not mean silver becomes more valuable per ounce, but that silver's percentage gains may far exceed gold's. If gold rises steadily, silver can triple or quadruple in the same cycle. Bank of America's bullish stance on gold reinforces this logic. Widmer argues that investors should allocate at least 20% of their portfolio to gold, with data since 2020 justifying 30% or more. This is an extraordinary recommendation from a major bank, signaling deep concern about fiat currencies, debt levels, and long-term financial stability. When gold allocations rise to this degree, silver almost always benefits as a secondary inflow asset. Gold builds the foundation, silver rides the wave. Think of gold as the anchor and silver as the sail. When the wind of capital flows into precious metals, silver catches more wind and moves faster. This is why silver often delivers shocking moves that catch the public off guard. By the time silver is making headlines, the move is already underway. At ground level, independent experts are echoing the same message using technical analysis instead of historical ratios. Rashad Hajiyev's forecast focuses on price structure, consolidation, and breakout behavior, patterns that even a child can understand if explained simply. Markets do not move straight up forever. They climb, rest, and then climb again. These resting phases are called consolidations, where price moves sideways while buyers quietly build positions. According to Hajiyev, gold recently completed its longest consolidation since the bull market began in 2023. That long pause resulted in a powerful breakout, historically leading to gains of 20% to 30%. When applied to gold's current price structure, this projection pushes gold well beyond $5,000 per ounce. This aligns perfectly with Bank of America's aggressive allocation recommendation. Institutions do not increase gold exposure unless they expect structural problems ahead. Silver follows gold, but with more drama. Hajiyev explains that silver is setting up for a triple-digit shock, initially targeting $114 or $120. This level is psychologically important because humans struggle to believe silver can trade above $100. That disbelief is exactly why markets overshoot. By the time belief arrives, price has already run far ahead. Hajiyev warns of a sharp pullback after this first explosive move, potentially dragging silver back below 100. This pullback would not signal failure, but rather a test, shaking out weak hands before the next major leg higher. Historically, silver bull markets are violent, emotional, and uncomfortable. They reward patience and punish panic. If investors survive that pullback, Hajiyev sees silver riding a final wave toward $180 to $200, with silver mining stocks amplifying those gains even further. When you connect Widmer's historical ratio analysis with Hajiyev's technical structure, a clear picture emerges. Silver is not just undervalued. It is positioned for asymmetric upside. Gold provides stability. Silver provides acceleration. The world is drowning in debt. Currencies are being diluted, and investors are slowly waking up to the fact that paper promises lose value over time. In every major monetary reset, precious metals reprice violently upward. Gold moves first to protect wealth. Silver follows to multiply it. This is why silver shocks markets. not because it is unpredictable, but because people underestimate how fast fear, greed, and capital can move once confidence in the system breaks. Silver does not need perfection to surge. It only needs pressure. And right now, that pressure is building.